Hi, welcome to this month's webinar on from QED Capital. And this month we've chosen a very important topic. One of the uh, two main goals whenever I hear about goal-based planning is one is children's fund or education, and the second one is retirement. Uh, given the given the way our country is growing in terms of population and in terms of how savings are getting financialized, or given the way historically Indians have saved, I think retirement somehow or the other we make sure that we have enough for our children, but I don't know whether we save enough for our retirement. And to discuss that and to share his research and views on this topic today, we have a very special guest. We have Ravi Saraogi from Samasthiti Advisors, which is a SEBI registered RIA. One of the, like they say in India, it's there are more tigers in India than RIAs. So Ravi is among the rare species of RIAs in India, and we hope that tribe grows. So Ravi has worked at Northern Arc. He's worked at India Infoline and JP Morgan, and he's also very active with the CFA Society, and he's a co-founder of Samasthiti, which basically, I think his philosophy is very simple but very robust and profound, and I'll let him talk more about that. And the way we'll be doing this is that Ravi will be making a presentation for about 20-25 minutes, and then we'll open up for Q&A for 15-20 minutes. So with that, Ravi, over to you.
Thanks a lot, Anish, for that introduction, and thanks for inviting me, and a very good evening to everyone. So like Anish mentioned, I'm co-founder of Samasthiti Advisors, and I am a SEBI registered investment advisor. And what we do is we undertake financial planning activities, for the client, and the idea really is that we do financial planning in a textbook way, how it is actually supposed to be done in a very comprehensive way. And a lot of what we do is we use a core satellite approach where we make use of passive mutual funds and a combination of a small amount of active funds to build really long-term portfolios for clients so that they can achieve all of their financial goals. Now, like Anis mentioned, retirement is, of course, a very important financial goal. It's nearly universal in its appeal. It's there in everybody's wish list, but it's a very challenging financial goal to address because it's a very complex goal. Most financial goals are one-time goals. If you want to build up education corpus for your children, you build an education corpus and then it is used over the next few years, and it finishes. But in retirement, you're building a corpus, and then that corpus has to pay a pension to you for the rest of your life expectancy. So this is actually a very complicated thing to do, because you have to make sure that the corpus accumulated is sufficient. You have to make sure that the withdrawal strategies are happening properly, and you have to make sure that the retirement corpus is able to anticipate changes in market returns, interest rates, and essentially you have to make sure that there is capital preservation, and at the same time the returns are adequate, so that it doesn't the retirement portfolio doesn't exhaust itself before the investor's life expectancy. And so they're going to be talking about this particular aspect. And I think a lot of the talk will be based on a paper that I had written, which is trying to compute the safe withdrawal rate for the retirement portfolio in India. So this study was primarily done because there was a severe lack of data in terms of how to really think about constructing a retirement portfolio. Most of the approaches are very simplistic, and the return assumptions, and the construct of the retirement portfolio was very rudimentary. So this is just an attempt, to try and fill in that gap in research. And the idea was that maybe this will further attract research in this area pertaining to the Indian markets. Now, while there could be a lot of research on retirement planning with respect to financial markets abroad, but particularly with respect to the Indian markets, there is very, very less data. So what we'll be doing in this presentation is, we'll be taking a look at a typical approach towards retirement planning, the safe withdrawal rate analysis, and how that can be used for retirement planning. Why do we need to adjust, this analysis for the Indian case? What has been the output, and what does the conclusion look like as part of this study? So now let's take a the typical way that retirement planning has been done. In fact, if you have been exposed to the online retirement calculators, this is what they essentially do. Where we calculate what is the retirement corpus that is available. Assume a rate of return, some inflation is assumed, estimate how many years the retirement corpus will be required, and then a monthly retirement income is calculated, right? So if you look at a typical retirement calculator, right, we have some assumption for retirement corpus. There is an assumption for the asset returns, be it equity and debt, some assumption with respect to the allocation between debt and equity. You have your time period. And so for example, if you have about if you need about 7.8 lakhs of retirement income, then you need a retirement corpus of 100 lakhs. Now, of course, in this particular example, we have not factored in the inflation. And if the retirement calculator is a little bit advanced, what they will do is they'll incorporate an inflation, calculate an adjusted rate, and tell you that not the entire income from the retirement portfolio can be consumed, but only a part of it can be consumed, because you need to inflation protect the retirement corpus. So this is pretty much, the complexity to which most retirement computations go to, and it's inadequate because this entire analysis is based on averages. A standard inflation rate is assumed, and an average asset return is assumed, and then the computations take into account the fact that such returns will be earned in a linear fashion, which is not really the case, right? Because the average return that a portfolio earns, it ignores what is the sequence of return, in which that average return was earned. So in what we planners call as sequence of return risk. Now, to take a look at how the sequence of return risk, makes a huge difference. This is a small example, of a portfolio which is going through decadal variations, in its return, right? So while it may earn 8% or 10% return over its entire period, but in between different periods, it's earning different returns, and that can actually lead to an early exhaustion of the retirement corpus. And this particularly happens when the retirement corpus in the initial years, earns a lower, a rate of return. If that happens, then the entire computation based on averages, it goes for a toss. Now, to account, for this problem, there was a study done by Bengen. This is a very famous study. It's called Determining the Withdrawal Rates Using Historical Data. William P. Bengen was a financial planner himself. He ran his own advisory practice, and he calculated, how much should you withdraw from the retirement portfolio in such a way that you don't exhaust it, before your life expectancy. And he pioneered the concept of a safe withdrawal rate. And for the US markets, he calculated that at 4%. There has been a significant lack of research on what this number should be, in different geographies. And in the absence of that, most geographies can continue with this 4% study. And what I have tried to do in my retirement study is to calculate what this safe withdrawal rate should be for a country, like India. So let's take a look at how the safe withdrawal rate can be calculated for India. What have essentially what we have done in this study. So we looked at historical data. So the S&P, BSE, Sensex. So that's been taken as the proxy for the equity returns. The price index is available from the year 1979 onwards. So we have taken that, and that's what you see on the screen. We also took the debt returns, which is challenging because while for equity there is the Sensex index and that can be a proxy for equity returns. In the case of debt, there is no such index which you can really use. So what we have done is up till the year about 1995, we have used deposit rates as given by RBI, 1 to 3 year deposit rates. So it's essentially short-term deposit rates. And beyond that is when liquid funds. There are liquid funds which go back up to 1995. So we have taken the liquid funds, the old liquid funds, like for example the Aditya Birla liquid fund. We have taken liquid fund data to impute what a short-term debt portfolio will return, and we have constructed a debt index. So these two indices tell us what the returns were in equity and debt for the period of the study. Next, the idea was that we look at every. So let's take a typical retirement exercise where somebody is retiring at 60 and say has a life expectancy of 90. So essentially 30 years of retirement expenses have to be funded. So we identified all the 30-year periods starting from 1980 onwards. So 1980 to 2010. So that's one retirement path. Then 1981 to 2011, that's another retirement path. And we went all the way up till 2006 to 2036, right? So that was so we have essentially 27 different retirement paths. Now, if you notice in the 27th retirement path, this goes from 2006 to 2036. So beyond the year 2023, we have used projected returns. And the reason why we have included out of sample retirement paths here is because the study has to be robust. There has to be adequate retirement paths for the data to make sense. We assume a 60-40 portfolio, 60% debt, 40% equity. Everything happens on a monthly basis, additions, rebalancing, withdrawals. We ignore transaction cost and taxes, and we project these returns for the asset class. I think everybody will agree those are conservative returns. So the calculations should be robust, and this is the safe withdrawal rates that we get for India. So the way to interpret this data is that for somebody who was retiring in the year 1980 and had the next 30 years of retirement ending in 2010, they could withdraw about 9% from their retirement portfolio. And that's a fantastic number, right? And the reason why the withdrawal rates look really good for the period prior to the early half of the data, the safe withdrawal rates look really good is because nominal returns used to be very very high. If you look at 1980s and 1990s, those were terrific years from a nominal return point of view. For example, interest rates used to be quite high, and that was because inflation used to be quite high, and equity, when it used to do well, used to have better nominal returns. Of course, that doesn't mean much because this is all a real return game. But from a nominal return point of view, the safe withdrawal rates used to be quite good. So you could withdraw a very good number from your retirement portfolio. Off late, in the second half of the graph, if you see that there is a compression in the safe withdrawal rates, and that blue line is a linear trend. So you do see that the safe withdrawal rates in India has been falling, and it's not really a surprise. I mean, the safe withdrawal rate is simply a function of what is the return that the portfolio is earning, right? So if you look at the average monthly Sensex return or the average monthly debt return, both of these have been falling in the case of India. And a big reason for that is because inflation itself has been falling in the economy. So nominal asset returns also fall. Now, and of course, equity return has been falling. So a lot of time people think that if I hold on to equity, for a good enough period, I should make very good returns like historically, but that's not the case. Even if you were to look at 15-year holding periods for the Sensex, and if you plot a trend line, you see that there is a clear downward trend in terms of the nominal return that equity has been delivering. So the reason why I labor on this asset return, is that when we calculate safe withdrawal rate for India based on historical data, and if we are seeing that that historical return has been consistently falling, we are actually overestimating the safe withdrawal rate based on historical data, which means we have to adjust the data for both equity and returns. This is something that we do in the paper. We have shown the data for the unadjusted safe withdrawal rate, but we also adjust the return data, and then we do it. So for example, for equity returns, it's a very simple exercise to actually adjust equity returns, because when you calculate the decadal returns in Sensex, so let's look at 1980 to 1990, 1990 to the period 2000, right? You see that across both these decades, Sensex delivered, identical, CAGR return. But post 2000, you see that there is a clear structural break in terms of the return on equities for both the decade 2000 to 2010 and 2010 to 2020. You see that equity returns, have sobered down. So in calculating the adjusted safe withdrawal rate, we only take a look at data from the year post 2000 onwards. So the return data is simulated based only on that period. So that's, takes into account, the equity return adjustment. In the case of debt returns, we are working with the RBI inflation targeting regime. And so, we assume a long-term inflation of 4%, and then we assume that the debt returns will be a 1% premium on inflation. So that's at 5%. And then we list out all the retirement paths from the year 2000 onwards. Of course, there's not so many retirement paths. I mean, that's one of the problem in doing, research on financial markets in India. We are actually a very, very young financial market, and any kind of exercise, which looks back, stumbles upon the problem that there is not enough data, right? So we don't have an option but to use simulation for calculating the adjusted safe withdrawal rate. And so we simulate the equity returns. We need a distribution, so we fitted a distribution. It's, while it's a bell curve, distribution, but the actual distribution that you see has longer tails. So we have used, a fat tail distribution, for simulating equity, and we use random sampling. In the case of debt, we are working with a 5% estimate, and this is, the distribution of the safe withdrawal rate that we get based on adjusted data. And essentially, this is a summary: 35% of the times the safe withdrawal rate is below 4%. So which means that anybody who's using a safe withdrawal rate of 4% based on the international experience runs the risk of running out of the retirement corpus, and that risk is quite large at 35% probability. If we use a safe withdrawal rate of 3%, the probability that you will exhaust your retirement corpus is only 8%, which I think is, a good enough risk to live with. So for most people, I think a 3% number, looks good. And if you want to be ultra conservative, if you use a safe withdrawal rate of 2.6%, you know, there'll only be a 2.5% probability. So that's a negligible probability of exhausting your, retirement corpus. So this is how, the safe withdrawal rate, it can throw a very, very important light in terms of how you should think about retirement. And of course, this study is just the first attempt, and we need to build, more on it. And of course, this number of 3% comes as a shock to most people, when you tell them that, okay, I can only withdraw 3% from a retirement portfolio, and that can put a severe constraint in terms of, what is the kind of lifestyle you can afford during your retirement. But it's, simply a reflection of the fact that, financial repression is very much a strategy in India. It's not peculiar to only China. And if you look at the inflation between debt and, inflation, there is very little real return to be made in debt. So unfortunately, when you run a retirement strategy with 60% debt, and that 60% portfolio is not earning a meaningful real return, it is what it is, that the safe withdrawal rate, will be, quite low. And until the time our economy is structured in a way where it's very difficult to eke out a good real return from your debt investments. It's very difficult to break out of this low safe withdrawal rate. So yeah, I'll stop at that. And over to Anish, and happy to take questions. And we believe that this computation of retirement planning is a very very complex exercise, and we have to throw in a lot of data, and we have to be prepared for every eventuality in making sure that when we communicate to clients that this is an amount of pension income that you can target, there has to be a lot of certainty attached to that statement, and you have to be really sure that you have got the math correct. And this is an attempt towards that. Yeah, so over to you, Anish.
Thanks, Ravi. I think that was very robust and very well explained. And I think you guys, I think one of the few uh, studies done on withdrawal rates in India. We have, like you mentioned, there is a very famous 4% rate, which is typically used in foreign markets. But I think post the financial crisis, that number has changed. Now, how does one go about? I think the accumulation phase, as we've discussed many times, is where it's when we listen to now how are we going to make use of the corpus. Now, when we think about the accumulation phase, it sounds much far more simpler than the distribution phase, where we will be uh, you know you do too much, you will risk running out of money soon. And but if you adopt an ultra safe approach, then you risk out, you don't live life. And what else, what do you use money, what is the use of money if you can't enjoy your life? So how do you advise your clients, or what do you tell them in terms of, or how frequently does a retirement portfolio need to be looked at in order to adjust for all these kind of life events?
Yeah, so like you mentioned, Anish, the accumulation strategies are much more simpler compared to the distribution strategies. It's a relatively easier problem to solve, and what we always tell investors is that when it comes to retirement planning, the biggest risk you can take is not to take any risk. We make sure that we show data to clients that historically what has been the real return on debt investments. And there is a large chunk of retirees in India who maintain a disproportionate share of retirement assets in fixed deposits, or bonds, or government saving schemes. And when you look at the post-tax return on that portfolio, it's quite low. So there is no, I think the first hurdle to cross is explaining to clients that we cannot shy away from taking equity risk. It has to be there. That's the only way to build a robust retirement corpus. That's the only way to generate long-term wealth, and that's the only way to inflation protect yourself. So that's one big part of education that happens. That we cannot do retirement planning without a healthy allocation to equities. And I think once that bridge is crossed, it becomes easier to tackle the problem, from an asset allocation point of view. But I think for many of us from the finance industry, it sounds quite obvious that you have to take equity risk. But even getting clients to that stage can be quite a challenge.
So typically, now even uh, people are working up to. I mean, it's become very, it's very varied depending on the industry. Some in the IT industry, uh, when their highest earning years are in their 40s, but that's also one of the periods in which people get laid off also. And then they turn consultants, and then they turn, so there are a lot of these changing trends that are happening even in this. It's no longer can be taken for granted that if you are in a job, you're probably going to work till your 60s and accumulate wealth till that time. Or if you are if you are a doctor, then perhaps you start saving very late in life because you start earning late in life. So how do you adjust for a lot of these accumulation and retirement strategies for depending on what field of profession or for from what background your clients come from?
Yeah, so in fact, we have seen a trend where most people project retirement age of 55, and in many cases it's 50. People in the retirement competition, would want us to work with a lower number, when they want to retire. And it's not that they anticipate stopping work at that early age, but they want to be financially free. They want that the portfolio should be able to pay for the living expenses by as early as 50 and 55, right? And it is quite a challenge, because when we are running our calculators and we're running our simulations, it becomes extremely challenging, because now the corpus that the client will have to accumulate has to effectively fund the individual's financially free life for the next 40 to 45 years. So it's very very challenging, and I think in most cases the math doesn't work out. Which is to say that we unfortunately have to rationalize with the client that based on the current math, an early retirement looks difficult. But I also see that for most people, it's not really a heartbreak to get that news, because in any way they were not planning to hang their boots by that age. And in most cases where even say 50 to 70% of the living expenses can be taken care of by the age 50 to 55, they are okay, because if people are planning to quit their full-time jobs and become freelancers, they anticipate that I'll be able to get at least 50% of what I was making earlier, in a relaxed way. And if the balance 50% is taken care of through the investment income, then it's good. So it's a mix, and every single retirement computation is unique. So we work with the client for their particular case, and we are able to account for all of these differences and chalk out a strategy which makes sense.
Right. Typically, what are the instruments that you recommend, and or do you use to help clients build their corpus? And one other question I have, which is mixed with this one, which is that if clients have different goals, do you typically slot or do you allocate instruments or map instruments to those goals, or do you make one unified portfolio which comprises of goals? Right, it's a two-part question.
Yeah, so we don't construct unified portfolios.
Okay.
We what we do is we construct goal level portfolios, where the retirement portfolio has a certain financial instruments. Children's education, for example, will have a separate portfolio. Children's marriage can have a separate portfolio. Travel, emergency reserve. So we bifurcate the portfolio into all of these different financial goals. Now, even if there are overlaps between these different portfolios, we still bifurcate it. And that is because to have absolute clarity from an investor's point of view as to where they stand with respect to each of the financial goals, and also that when the financial goals come knocking, you exactly know where in the portfolio to go for and generate liquidity. So for example, if a particular mutual fund scheme is replicated across three different financial goals. So when we start the investments for the client, we make sure that that particular mutual fund scheme, which is being replicated across three different financial goals, has three separate folios. So at a folio level, it is mapped to a different, financial goal. That allows us to track very well, where the client stands. It allows us to do rebalancing, so we know exactly from which folio buying and selling has to happen. so as to achieve rebalancing. Tracking becomes a lot simpler. So this is it's more complicated to do because you have to start separate investments, all of those investments. I think the unified portfolio approach, from a simplicity point of view, cuts the work down a lot. It's I think easier from an execution point of view. But we go down the difficult route because I think it'll make things easier, subsequently.
Correct. Like if you want to, redeem funds for your child's education, then you know exactly which one you're going to touch and which one you are not going to. Otherwise,
Absolutely.
you
Yeah.
and again you have to make one more decision at the time of redeeming. Okay, how much of what should I redeem at this point in time? So yeah, you're
Yes.
right. This makes it much more clearer at the time of redemption.
Yeah, and to your question as to what are the kind of instruments, I
Yeah,
think mutual fund is an excellent war horse. It's suitable for a variety of reasons, and I think the bulk of the heavy lifting is done through the mutual fund route. Of
right.
late, for example, of course you do a lot of work on factored investing. We like factored investing as well, so we get hamstrung when we try to give factored exposure through the mutual fund route. At least earlier, we could use the fund of fund route, but post the tax change, that becomes a problem. And we don't want to use factored ETFs in India directly because of liquidity reasons. So mutual funds works, and of course, what we do is, we explicitly account for the fact that, okay, if somebody has a PPF account, we put it part of the retirement portfolio. We factor that, PPF, client will be contributing 1.5 lakhs, each year. Most people have EPF or NPS, so we take that, that's part of the retirement portfolio. In the case of children's education for a girl child, there is Sukanya Samriddhi Yojana, apart from, of course, equity mutual funds. So we look at all of these products, and of course where the portfolio size allows us, we are open to looking at AIF and PMS. So we are not really we don't really cut ourselves that, okay, we can only look at this instruments. It's all depending on
Fair
client
enough.
requirement, but mutual funds, I think are your go-to vehicle.
Most people also go for annuities. What is your view on annuities, pension annuities,
So
pension plans?
actually, yeah, actually, most people, for example, who buy the guaranteed plans are not really buying it from a guaranteed annuity point of view. In most cases, they're not even aware that, okay, this policy that I'm paying will have some guaranteed annuity 10 years later. And that's purely because of the way these insurance policies are sold. I mean, there is no investor education really happening at the other end. I mean, these policies are indiscriminately sold. I think a lot of cases where we have seen such annuity policies, the client is actually not even aware. It would have been great if a client is buying an annuity, from a point of view of being aware, because that shows that there is awareness with respect to retirement planning. There is awareness with respect to how do I create a pension income. It's a different aspect whether we believe annuity is an efficient product or not. But
Right.
from an awareness point of view, if clients were actually buying annuities, being fully aware of what that product is, it's a good trend. But what annuity, for example, if we calculate the IRRs for most annuity products, it's not much to write home about. But for a conservative investor, in some cases, it makes sense. So for some clients, given the risk appetite and the IRR projections of certain guaranteed pension products, it actually makes sense.
And uh, one unknown variable in all of this is usually tax. And when we include tax in the whole picture, uh,
Yeah.
that that changes things. So is that something that impacts your withdrawal rates a lot, or is that something that's okay? You can assume that broadly you will be in this tax bracket, and that works.
Yeah, no, actually, this the taxation on the withdrawal part we take into account explicitly, and the recent withdrawal of indexation benefit for debt mutual funds, that has
Yeah,
really been a big blow. It used to be our preferred way of generating a monthly income by using a systematic withdrawal plan on units which are more than 3 years older, and getting the clients indexation benefit on that. Particularly for clients who were there on a 30% tax bracket, this was an excellent strategy, and it's really been a struggle, to see, okay, how do we now make up for that additional tax, right? Because see, I think as an advisor, the challenge always is that you can always increase expected return, by trying to construct a more riskier portfolio. Of course, a riskier portfolio doesn't always mean you will meet the higher expected
you will.
return, but
Yeah,
you can orient the portfolio towards higher risk in the hope of making higher return. But that's not a flexibility that is there always, because the client's risk appetite can be very different. So it's been a real bummer, Anish, and I think it has put strain on a lot of retirement portfolios. And for many cases, for example, where the client, say for example, if somebody is targeting a pension of 1 lakh a month, right? So essentially the portfolio needs to generate 12 lakhs a year. So in that case, the client is effectively sitting in the 10% odd tax bracket. So there it's fine, right? Because even if you are generating that through interest income, the
correct.
tax, a lower incidence of taxation takes care of it. But the moment the client approaches 30% tax bracket, it's been a bit of a problem.
Yeah, so basically you have to keep on reviewing maybe at least once a year or once in 2 years, or when some of these events kind of occur, and take a and relook at your retirement portfolio at that.
Yeah, so actually, for most retirement portfolios that we are managing, we are actually, doing a quarterly review. So where we are actually, so the accumulation phase of the retirement strategy, so that's fine. An annual review is sufficient. That's, you don't require much tinkering. But where it's distribution, there the touch points have to be higher, because as an advisor, you just want to make sure that you are not overspending from the retirement portfolio. So even if you have all the calculations pre-configured, you would want to keep updating those computations based on the last 3 months data, just to make sure that you're not in any way putting the it's too much of a risk to look at that portfolio 1 year or 2 years on the line, and then make a correction in case anything is going wrong. So I think for distribution strategy, you have to actually work with a quarterly touch point.
So, one of the last few questions is in terms of the asset allocation. Uh, Even like you rightly mentioned, right, that even if you are in retirement, you do need to keep some amount of equity exposure, because equity perhaps is the only instrument, gold to an extent, but equity is the only instrument which will help you beat inflation. So at the minimum, like even say somebody who's in their 70s or is going to their 80s now. Now, I mean the latest retirement surveys all say that and looking at 50-year-olds today, that one in three or will reach the age of 90. So, what is the minimum amount of equity that you think people should keep in their retirement portfolios?
So I think even for the most risk conservative investor, we at least look at 20% equity exposure. So that's, I think, you can't do without it, right? And I think the way to look at it is, if you have provision for the client, for the next 10 to 15 years of expenses to be met out of the debt portfolio, the balance, if you allocate to equity, right? So that itself, easily clients can allocate 20 to 30%. So even for the most risk conservative investor, we tell them that this allocation to equity is happening after providing for 15 years of your living expenses, right? and
Correct.
and if you look at data from 1979 onwards, there is not a single 15-year period over which equity, has not given a respectable return. At least the minimum return would be in the range of 5%. So essentially, even if you are the most unluckiest investor, equity over a 15-year period will at least cover for inflation, and that way it actually comes close to debt return. So that's the way, we look at it. But 20% is where, we have to start.
Yeah. Yeah, you're broadly in line with what Ben Graham said. So he said that he recommended that he said two things are the most important thing: asset allocation and security selection. But for most people, asset allocation is the most important thing. And he said he at least for himself he said it's he keeps equity. He used to keep equities anywhere between 25 to 75. So minimum never go below 20 25. You said around 20, so that's broadly
Yeah.
the ballpark. And max season he was in the range of 75. So I think that's broadly it. And you're right. We do need equities. Even I think that is one of the most important information that retirement, that you don't need equities in retirement, if you that it's going to be an all debt portfolio, and you don't need to take any risk for the next 20 50 years. So anyway, Ravi, thanks a lot. It was very
Yeah, and maybe
insightful.
Anish, I have a question for you.
Yeah, yeah,
Yeah, given your substantial work in factor investing, maybe you could share
yeah.
your perspective on what is the role that factor investing can play towards retirement planning.
So I think what it can do is, we've been doing some work on factor. So we hear a lot about asset allocation, but now after uh, 2008 crisis, people started also looking at factor allocation. That what are the factors that are is your portfolio exposed to? And they obviously, it was in hindsight obvious, but one of the biggest factors that an equity portfolio was exposed to was the growth rate of the economy, then oil prices, and then it came down to inflation, and then within that, then they started looking at styles, which is what we typically in equity we have, value, momentum, quality, and size, and low volatility. So I think those when you construct an equity portfolio, I think being aware of at least these cycles and taking benefit of the diversification of these factors. For example, value and momentum are the least correlated. So if you are building an equity portfolio and you want to add a little bit of uh, optionality, or having a little bit more returns than an index, but you don't know which mutual fund to take, or which one is going to do well, then I think there uh, this can be an interesting addition, saying that okay, I'm diversifying between styles also, and between styles which are not heavily correlated, which are value and momentum. For example, value has not had a great 2010 to 2020, but it post the vaccine, value has had a fantastic run. Value stocks have picked up like crazy. Not that, and momentum has also done equally well, but not as well as value as well. So, and for some investors, let's say you want to pick a low volatility portfolio. Most would think conventional finance tells us uh, that higher the beta, higher the risk, and so higher the return. But we've seen this low volatility anomaly. The only reason they call it an anomaly is because it doesn't fit in with the efficient market hypothesis and things like that.
Yeah.
But it is now widely regarded as a factor by itself, which I think is a very important one, which can play a role, because for if you are getting higher returns with lower volatility than the index. I think what could be better than that? Of course, it comes with its risk that you will not be outperforming like crazy in a very strong bull market. But at the same time, you will not be falling as much as the index in a down market. So if an investor is able to get that message, and harvest that amount of low volatility premium. I think even that is a very good factor that could play a role in a retirement.
No, absolutely, totally. In line with this, where, for example, in the satellite part of the
Yeah,
portfolio, I think, I think retirement planning is particularly suitable for factored investing, because factored investing, whichever factor you are, pivoting to, those factors can be out of flavor for many years, right? And which is why factor investing requires a runway, and I think retirement portfolios can give factor investing that runway to really achieve its true potential. So no, so thanks for that. Yeah.
correct. Yeah, and just to add, now that we started on factor investing, at least you know what style you are exposed to, because
Yeah.
with mutual funds, while the fund manager has the discretion, so whether he's going to play the growth style, whether he's going to play a value style, whether he's going to play momentum, it's not given all the restrictions, and even what we've seen in history, it's not, you are taking, at the end of the day, you are taking a call on the fund manager, but here you're taking a call on the strategy itself. So upfront you have a lot of historical data, you have and you can ask for data saying that, okay, I need to know how your portfolio is constructed, what are the rules that you use, and things like that. So you can be the uncertainty around your outcomes becomes much lesser. So I think that also plays a role.
Perfect. So thanks for having me,
Great.
Anish. It was a pleasure speaking to you.
Thank, Thanks, Ravi. Thanks for coming, and look forward to hearing from you more on your work on retirement portfolios, and all the best to you. Thank you so much.
Thank you.